is like sort of the first year in our history for the PIC that we've been fully invested. The year prior, we didn't get fully invested until basically September 16. So this is our first full year reinvested. So when you look at the dividend especially, you'll notice that is a significant step up and more consistency to our dividend payout. And that's because of, we're in the market, we're getting a dividend strip from what we receive in dividends, plus, as Andrew mentioned, we are an actively managed strategy, so portfolio turnover runs between 30 and 50% most of the time. We will take profit. I've got one eye on my franking account balance all the time as a company now these days, a bit different to when you're running a trust. So that you can see that here where the profit was quite strong. We took we took some gains in a lot of our overseas stocks. If you look at our performance, I'll get to the performance chart at the end. A lot of our performance did come from global. About 500 points above the market came from global alone of alpha. About 280 out of Australia, and we had a 250 point cash drag, which tells me that I should be probably trusting my own bets. The dividend at 4.7 cents for the full year, fully franked, is pretty important because that's now we're at a level where we feel we're getting at least a market dividend yield, and we'll be able to hold that especially. The franking balance, if you go through the accounts, you can see the franking balance is well ahead. So for the next 18 months, if we do nothing, we can fully frank the dividend from here and actually grow it, more importantly. We're trying to maintain or grow the dividend, some sort of a progressive dividend policy. But given our style as a value manager, we tend to always have a reasonable franking balance coming through most of the time for our dividend pool of the securities we have. And because we're active, hopefully, in most markets, we're trying to build a buffer so when markets aren't the best, we can still pay the fully franked dividend through and maintain our dividend while others may be cutting. So the NTA now is at about 110, 111. It's gone X, 2.5 cents already, so that's already in the NTA. And the performance this year was 17.5%. Now that performance is after all management fees and all expenses for the PIC to run the PIC, but pre-tax. So just that's what we deliver. And obviously because it's a company, as I said, we're always quite interested in generating franking credits. I'll just quickly go through the top three stocks we have there. Woolies, as we just discussed. We've got a slightly different opinion on that. That's all right. As I said, it's a market. So with Woolies, our view is while optically it looks 21 times, looks expensive, the fact that they had $110 million bonus paid out in the second half, that won't happen again. For the staff, they hit their targets. Secondly, everyone's basically now pricing a $150 million loss for Big W forever. We think management will walk that back over time by actively managing it. There are issues. It is a big lease book, and that's what you've got to worry about in those things. But remember, they've been focusing on the supermarket operation pretty much exclusively for 18 months. It's now got hit its straps. So while optically there's $110 million there, $150 million loss in Big W, I think you can work those back out numbers. Plus, they're still running quite high wastage versus Wesfarmers. They're probably about 100 points above in their business of waste, which is they had to do that. They had to put stock on the shelves and run with more waste because they lost the customer effectively. So it looks like they've got the customer back. Next, start to manage it. We've also done some work where we've identified about 200 basis of labour over and above what cotton in their stores. So we think there's labour savings they can now manage. Again, with that $1 billion investment, it will staff as well. They put a lot of staff in because, again, they lost the customer. So now they can actually, you over-engineer at the start and then you start to get back to what you think you need. So we think they actually still got quite a few levers to get what looks like 21 times a lot lower in multiple. Thirdly, if the BP deal gets approved by the ACCC, they're going to get a $1.6 billion check. Effectively, by next year, they'll be debt-free at the corporate level. They do have $1.80 of franking credits on the balance sheet. We're obviously in there trying to encourage them to pay that out as a nice big special. That'll be great for us, especially the PIC, because I need the franking credits. So, as I said, we think the operating momentum is continuing. And with these businesses, particularly the biggest business, when it gets operating momentum, they're hard to turn. So actually, they have to really cock it up. You have to lose customers by doing something poor. So if they stick to message, we actually don't think Coles can do much in response. When the gorilla starts swinging its arms around, it's a lot. You can't do much. Remember, they're 20 to 30% bigger. And they've got the best floor plate. So they've got the best locations. What's encouraging for us, though, is to stop rolling out space in a big way, which is with square metres. And if you always look at how the CEO gets remunerated, CEO gets paid on profitability per square metre effectively. And so the easiest way to do that is stop rolling out square metres and get more efficient. So we still quite like Woolies. I've actually been buying more back in the 25s at the moment. We sold quite a bit because it was 12% of the PIC, got it down to about 7.5 to 8. We're now buying it back again. We think it's a good entry price here. I think the market's sort of ignoring the operating momentum. How these things get, the positive operating leverage is enormous when it gets going. On Star Group, second one, we actually think it's about the right time. We're probably a bit early on Star, but you're at the end of what is their on-balance sheet CapEx. So, you know, the hotel at the Gold Coast, at Jupiter's Gold Coast now, not called Jupiter's, just the Star Gold Coast. That'll be the last thing they do fully on balance sheet, and that opens in November, soft open. It's doubling the floor space in at the Gold Coast Casino for them, which it's been a space-constrained product. They haven't been able to put tables on the floor when they need to. It's been quite poorly. It's been underinvested for 15 years. So it's going to be brought up to at least a decent standard. So we quite like to start. More importantly, from here on in, every other piece of any hotel or gaming development is a third of theirs. So Chow Tai Fook and Far East will fund the other 2/3. So the new tower that's being built, it's already been marketed actually on the Gold Coast, is they're putting in, I think, about $60 million of their capital in for that. And if you think it's a hotel and apartment, a third of the hotel will be comped to Star. You should expect those customers on the floor. That's what it's about. Casinos are all about how many hotel rooms you have available to the floor, right? So they're adding, and if there's another 2 more towers going up over the next 8 to 10 years, which is not paying 100% of, our incremental returns are that they're going to do between 30 and 40% incremental returns on that CapEx that they're doing now, because they get the benefit of the staff, of the pull through the customers, but not 100% of the CapEx. So for us, it's very, if you look at charts of casinos, you don't buy them when they're in huge CapEx phase, because they have to 100% fund it up front. It's a very different model now. So we quite like Star, and we think they, more importantly for us, they'll be able to grow the dividend quite aggressively, because their debt is in a good position. They can fund it all without having to go uncomfortably over. So they'll be able to grow the div with the earnings by 5 to 10% a year. The last one there, Oilsearch. We've been buying oil more aggressively over the last 6 months. We've done a bit of work on where the shale guys are, etc. And if you look at the EIA and EIA, sounds like a song, they've consistently overestimated shale production, and they've actually underestimated demand for barrels per day growth, barrels per year growth. So they've consistently overestimated shale volumes by about 10% every month. And there's no conventional fields there hasn't been a new discovery for a while, 8 to 10 years. Those decline rates, typical decline rates on that, and with shale, the efficiency, and you can see the recount numbers starting to fall now, it's not there. Half of the shale market is privately owned or small companies. The other half is with the IOCs, the international integrated oil companies. Those guys run it for cash flow, right? So our view is, if you do get actually a steepening yield curve, those guys have significant debt loads. That's how they finance themselves. There's only one way for them to get out, is to either sell to a large guy, or they basically start running the operation down. So the cost of their balance sheets are what will restrict their growth. So we still quite like Oilsearch. Oilsearch being probably the highest quality, and that's what we go for, the highest quality at a reasonable price. And with Oilsearch, the elk antelope is probably the next. If any development gets done globally, it's going to be elk, for sure. Now, there's just going to be an argument between Total and Chevron as to on how they argue about who gets the benefits. But we like Oilsearch, we like the CEO, the way they operate, the balance sheet's in good nick as well. So it's that's how we played sort of energy. We've been underweight resources. We've been 4.5 to 5% overweight AWAC. That's how we tend to play it. We tend to play it pretty aggressively, and we've had quite a bit of Billiton as well in the portfolio. Don't own any Rio, don't own any Fortescue or the other names, or South 32. We just played through that. On the global side, our preferred now is Shire, which is a UK-listed healthcare stock. They bought Baxter's spun-out plasma business. They paid a stupid price for it 2 years ago. They paid 10 times revenue. I don't care, because this business now trades at 9.5 times, so it's well and truly in the price. The market's effectively written off 90% of the value. The thing is, that asset's it's a great asset. If you look at their IG business, the immunoglobulin business they got, I think it's better than CSL's, because they've got 4 or 5 products that service the entire market. CSL's basically 1.5 products. CSL's extremely well run, right? And they are a well-run business, but I think the Shire's assets are as good. The only problem they've got, the White's trading at 9.5 times, is they've got a haemophilia franchise, which has got a bit of competition coming into it. But at 9.5 times, our numbers show that Mark's pretty much written off 60% of that haemophilia franchise, which is 25% of the business. They've just written it off. Okay, and we've done quite a few surveying of clinicians in the US, Germany, and UK about their conversion rate to new products. The market's priced in 50%. Clinicians do not shift haemophiliacs onto new products straight away. Given the experience, firstly, haemophiliacs don't trust governments or anyone else. Given what happened to them in the 80s and 90s when they were basically poisoned by HIV in the blood system, so they're basically very conservative. So our view on the clinics, we did a survey on 18,000 patients, and it's going to take a lot longer than everyone thinks, which is fine because the market's overstating the rate of decline. So Shire, it's about 9.5 times. It's generating it's on about a 12% free cash flow yield. So it's got a bit of debt, but it's delevering really quickly. Okay, so we expect the risk with this one is that they've always made acquisitions. If you listen to what the CEO said and what the board said, there's no M&A. It's all about paying back debt, and if they're trading at these levels, buybacks. It's the most efficient use of their capital. So like Shire, AXA, you couldn't get more boring if you tried. Half life, half non-life, 30% France and Europe. Trading on a 15% discount to book value. They pay out 50% of their earnings. It's doing about a 4.5% yield. They've got a business in the US, which is about, again, 30% of their book. It's more a non-life, a life and an asset manager business, AllianceBernstein, they own. 9.5 times with a reasonable yield. And it's extremely well run. They've got a great Asian wealth management franchise in AXA. And they're pretty upfront in saying if rates stay where they are globally, we're going to do 3 to 5% EPS growth. If you get any lifting in rates anywhere, we'll do between 7 and 12% growth. And they're quite aggressive with their capital management. So they're looking at now spinning out their US business with the fund manager, AllianceBernstein, and the non-life book, or the life book. If you look at asset managers, they're fortunate because asset managers are re-rated pretty much globally now. They're on 15, 16 times. Their attitude is we're going to sell it if we can get 14, 15 times, we're going to sell it and we're going to buy back stock. So you're going to get quite a bit of EPS growth and, more importantly, dividend growth out of it. And they can easily maintain the dividend because they are only paying out 50% of their earnings. So you're quite protecting the dividend stream we're getting out of it as well. Last one, Bank of America. We actually sold quite a bit at the start of the year. It was one of our biggest, it was like 8 to 9% of the portfolio. We sold quite a bit down to about 2 to 3%. Actually, in the last couple of months, we've actually bought it back because the bank stocks have basically been held back in the market. Everyone's been buying the yield trade and PE expansion trade. So Bank of America sat out there with 10% earnings growth on 10, 11 times, trading at book value still. So us, very attractive. And we've obviously, from what I'm telling you, I've got quite a bit of rate leverage in the portfolio, and that we're going to get a steepening or a lifting over time. We should do particularly well out of it. In Australia, mentioned we own a bit of Westpac for that as well because it got quite cheap during the year. Other than that, we don't own any other banks. My other preferred bank is Clydesdale. It's about 6% of the PIC. Like what they're doing. The way you trade it is in between reporting seasons, people kick it around based on purely macro, right? But they always come in and they deliver a good result because management, look, when you're running a 60% cost to income ratio, they've got a few levers to pull. And then you get the benefit of tailwinds if, firstly, Brexit slowed, from what it sounds like it might happen. But more importantly, Carney's already come out, the Bank of England head saying rates got to go up. And these things are close to 100% deposit funded. A third of the book is, or 25% of the book is transaction accounts where they pay no interest. So enormous leverage to that. So that's a cyclical component of the trade. I like that the company specific is the idiosyncratic risk you're taking is, I think there's a lot they can do with the business. So that's the other one we like, Clydesdale. I'll leave it at that. I might just move on just to the performance just to highlight it because they're good actually. That's the only reason. We've had a decent 6 to 12 months again. We have been carrying about between 18 and 20% cash average through the period. So, that's my bad for not maybe being a bit more aggressive with some of our bigger overweights and putting more money into them. But we are conservatively managed. So we've been able to get the returns with well below market risk. Okay, we're getting those returns by taking less than market risk, which is important. we are conservative the way we run things. We need sort of extreme valuations opportunities to participate. We don't just chase the market. That's not our style. We're not momentum chasers. But when it happens, like with Shire at 9.5 times or AXA at 9 times or discount the book, we're quite aggressive. And obviously in this market, there is not a lot of obvious value at the moment. Typically, for us to be fully invested, we'll be cash will get down to between 8 and 10%. We probably won't go below that. That's for us fully invested in the PIC. Because we like to have a bit of cash there to take advantage of opportunities because we can be quite nimble. And secondly, we've got to have a bit of cash to pay the dividend as well.